Episode 8. Risk is not a number, it's a location. Most traders think risk is a calculation. A number, a stop size, a dollar amount. It isn't. Risk is where you're wrong in the auction. And if you don't understand where the auction fails, every stop you place is just a guess dressed up as discipline. You've said this before, almost everyone has. The idea was right, I just got stopped. That sentence feels honest. But it's usually not true. The idea wasn't right. Because if the stop got hit, the auction already told you something changed, and you ignored where that mattered. Most traders place stops where they feel comfortable. At a fixed number of ticks. At the low of a candle. At some arbitrary percentage that sounds responsible. The market doesn't respect any of that. The market respects auction failure. With Harmonia, risk becomes simple and uncomfortable. If price invalidates the current auction outcome, you're wrong. Not early, not unlucky, wrong. That means stops only make sense when they sit beyond structure. Beyond equilibrium when you're trading rotation or early distribution. Beyond the 20% when you're trading accepted continuation. Beyond the extremes when you're fading exhaustion. Anywhere else is just noise. Let's break this down. If you're trading rotations, failed 20% attempts, or early distribution setups, your stop belongs beyond EQ. Why? Because EQ is fair value. If price reclaims it decisively, the rotation thesis is over. The auction didn't hesitate, it rejected your idea. Stops inside EQ don't protect you. They protect your ego. Structure-based stops survive because they align with how the market actually resets. Now the most important one, continuation trades. When the market accepts the 20% and you trade the pullback, your stop does not belong at the 20%. The market is allowed to test acceptance. It is not allowed to fail it. If price closes back inside value, if acceptance is lost, the auction changed. That's not drawdown. That's invalidation. Exit. And then there are exhaustion trades, the ones everyone wants to be clever with. If you're fading the 80% or 100%, your stop belongs beyond the extreme. Not tight, not hopeful. If the market wants to trend from there, you're done. That's why turtle soup trades either work quickly or they shouldn't be held at all. Here's the uncomfortable part. Tight stops feel smart. They feel disciplined. They feel controlled. They feel professional. Until you realize the market needs noise to function. Good trades breathe. Acceptance takes time. Rotations retest. Extremes probe before failing. If your stop can't survive that, it's not risk management. It's self-sabotage. Here's the rule most traders never learn. The clearer the auction state is, the less often you trade, but the more room you give the trade. You don't tighten stops when structure is clear. You tighten frequency. Harmonia is built around this idea. Fewer trades. Clear invalidation. Larger average wins. That's how professionals stay solvent. Once your stop is structural, position size becomes the real risk lever. You don't move stops to feel better. You don't widen risk emotionally. You adjust size. Same idea. Same invalidation. Different exposure. That's trading like a business, not like someone hoping to be right. Here's the hard truth. Most traders aren't losing because they don't know entries. They aren't losing because they lack indicators. They're losing because they don't know when they're wrong. Harmonia fixes that, if you respect it. You now understand where risk actually belongs, how the auction defines failure, and why most stops are placed in the worst possible locations. In the next episode, we're going to talk about execution timing, the difference between patience and hesitation, and why waiting is often the most profitable decision a trader can make.